I think, one, people have been flocking to the high yielders because they're relatively safe in this part of the market, and that's been the right call. And when you look at the 2015 to 2016 period, it was more data dependent, depending on what the market produces and then how do policies respond to it. And I think a similar process is happening right now. Now, what's on our side is that when we look at the business cycle, it does. It has turned, but it's just very weak. And based on the data we have, the trough was November 2022, and the peak is probably mid 2025. And in that broad trajectory, we have a non-consensus view, which is in the second half of this year, you could see signs of property markets starting to stabilize, particularly with the second-hand home prices. So that would be a big piece of the puzzle there for you. In terms of where the funding is going to come from, how it is going to be funded, or even if this is a discussion or a proposal, I think we kind of have to wait and see. But I think clearly market sense that the valuation is very cheap, and it's been a lot of extreme positioning, and then partly driven by structured product. So it is very much likely to come back to focus on fundamentals when some of these, technical issues are behind us.
And I'm sure that's the hope for a number of these companies. But I've got to ask you, because we've seen a raft of stimulus that we know for certain. We've got this one that is obviously speculated. And realistically, I can understand in terms of the reaction function that you're hoping to achieve by, what we read over the last 24 hours, because you're trying to shore up that negative wealth effect, because property's taken a beating, equities have taken a beating, and you're trying to sideways kind of juice consumption. But on the consumption front, that really is what everyone is looking for. Do you think there's any possibility that at the two sessions, perhaps, that we are going to see measures that are directly targeting the consumption story in China?
Yeah, I think that's very much what the market is hoping for. It's the demand side stimulus rather than the supply side stimulus, because I think the investors are recognizing more supply side stimulus is increasing capacity and adding pressure on pricing to the point that ROE and ROI are hurt. So I think, like you pointed out, if we see consumption side stimulus, that would be very good news. If we see market supporting measures, well, that would also be positive.
Just finally, because a lot of talk has been made about, the triple Ds in China and the deflationary impulses that we are currently seeing. Again, assuming all of this is true in terms of the stimulus that's been, bandied about over the last 24 hours, do you see this as potentially inflationary in China as well? Because I would imagine if you're willing to do this kind of a stimulus, there's a prospect for even more. And if asset prices get juiced on the back of this, that would then feed through, because that could have implications that are more far-reaching than just in China if we do see a return of any kind of substantive inflation.
I think if consumption comes back and if there's more consumption stimulus, the CPI would be less deflationary. And this is the forecast we have for the second half of 2024. In terms of exporting inflations, I think China is still some ways away from it due to the very heavy overcapacity. And if you look at the capacity utilization, it's only in the high 70s, and generally you would have a higher capacity utilization in Japan and US in the high 80s or even 90%. So I think there's still capacity slack in China right now.